Welcome, everybody. Thanks so much for joining us for the Powerplay Tuesday presented by Quest Trust Company. So today we are going to be talking about multifamily investing, specifically apartment complexes. And we have Mark Kenny giving a presentation today. Unfortunately, he was actually not able to join us live. So we do have a recorded presentation from Mark, and we'll get into that here in just a bit. We are going to have some time afterwards to hopefully try and address any questions y'all have as well. Put those down in the chat, and I believe Mark will share some resources towards the end to essentially give you some information on how you can ask questions to them as well. But if y'all do have some questions for me, maybe about how to use this through an IRA, I can try to answer anything about the multifamily side as well, though he would probably be a better resource for that. But put your questions down there as we go through, and we'll try to get to those the best we can. So really quick, to give kind of a brief introduction about Mark and his company, Think Multifamily. So Mark Kenny is actually the co-founder of Think Multifamily, and he himself has invested in over 1,300 units. Mark has a really I guess I would say top-notch reputation when it comes to the multifamily investment community for not only the way that he provides value to investors, but how he works with them as well. So to talk a little bit about Think, they acquire, own, and operate multifamily apartments, focusing on areas and markets that provide promising, I guess, sustainability and living situations, population-wise. So their business model also focuses on the opportunities for increased return by bringing new capital to eliminate deferred maintenance and bringing creative and modernized touches to these properties that they're acquiring. So providing better management and collections, negotiating better contracts, and ultimately improving the overall environment of the living area for their tenants, and trying to provide increased return to their investors that way. So they really focus on trying to work with real estate investors the best that they can. So with all that being said, I do just want to provide a quick disclaimer as well from Quest. We are not necessarily providing any sort of tax, legal, investment, or deal structuring advice with providing this information, right? It is for your educational purposes and for hopefully you to kind of be able to expand your knowledge when it comes to alternative investments, specifically in multifamily. So we're not necessarily endorsing any investments or products, and hopefully this kind of is a way that you can learn about some of the opportunities out there, but we're not necessarily endorsing one thing over the other. Okay, so I think that's all I have to get us started. Like I said, I'll be back on here in about 30 minutes or so once we kind of finish up with Mark's presentation to provide some more context, share a little bit about Quest, some of the events that we have coming up, and then I think we'll have some contact information for Think Multifamily as well if y'all are interested in asking them some questions. So Mac, we can go ahead and pull that up. I'm going to take this down. All right, then we'll get started.
Hello, everyone. This is Mark Kenny with Think Multifamily, and today I'm going to cover off some lessons learned in a down market, and as well as just whether you're a syndicator or an investor. It's kind of a mixture of different lessons. But I'll go through some of the current data that has existed. If you've been investing in multifamily for a while, things were great until they weren't great anymore. 11 rate hikes by the Fed. Insurance costs have been hiked. The examples where we had insurance go up 300, 400% in a single year. Most coastal markets, if you know what a rate cap is, that's more like a interest rate protection to some respects, but you can see that it's gone up drastically. I think at one point it was like 900% increase on rate caps. And this all happened in a relatively short period of time. It wasn't like it was over a matter of years. It happened very, very quickly, unfortunately. Utilities were up 40% last year. Labor costs, I think a lot of us know, have been up pretty drastically in a lot of industries. Property taxes in some areas have drastically increased as well. And evictions in some parts of the country, up until even 6 weeks ago, still taking up to 16 months to evict. So when people ask, what's the one contributing factor to properties that are having issues, and if you're in the market and you have any of these or multiple of these items going against you, you probably have some challenges, to say the least. But it's really a combination of a lot of things, and these are the main factors, in my opinion, causing a lot of the issues in the market. So people ask, are we at the bottom? Not going to predict, in my opinion, whether we're at the bottom or not. I do think that a lot of the large investors, the multi-billion type guys, believe that we're at the market, at the bottom. They've been stashing up cash, and now they're ready to deploy. Will the Fed cut rates? I have to believe that they will, but I will never guarantee that. But I do think that looks like that's very likely. They've been talking about it. They announced they're going to do it, and I did a analysis over a 2-day period back in January from 10 different so-called experts in the industry about the Fed cutting rates, and it was everyone had different opinion. So this is a matter of 2 days. So trying to make decisions based on daily information is tough. Will rate caps compress at some point? I would have to believe. The notion, or people say that cap rates and interest rates really aren't tied together, but let's be real, they are. So there is kind of correlation there. Is now the time to get back into the market? I do think that we own a lot of properties. We're very active with the brokers, and there's no question that the market sentiment has improved, even very recently over the last few weeks. Activity has been up so far this year as well compared to last year. You don't see as much of it because it takes 3-4 months to close a deal, but there's no question there's more activity. Deals that were on the market, buyers are coming back, and in some cases offering more than they were even 4 or 5 months ago. And then should you change your investing strategy? I am, without a doubt. There are a lot of different things that I would do, and I'll talk about some of these things as we kind of go through the presentation. Your buying criteria, very reluctantly buy in the areas that have been hit the hardest by insurance. So what happens is insurance providers pull out of a market, and that then gives the ones remaining the ability to charge whatever they want. So the ones that are in the coastal areas, my personal opinion, be leery. Doesn't mean you should never invest there, but definitely be leery about that. Buying landlord-friendly states. States relative, usually at the county level. But again, there have been some parts of the country where it's taking well over a year to evict. People are living there, building up balances, $10,000, $15,000, and you're not able to get them out. It's pretty hard to pay bills when you have people living there for free. It's not just free; they're actually, costing you stuff too. They're damaging the units and things like that. So, national average household income should be above the national average. If you're looking there, if it's not a distressed deal, distress is somewhat relative. It should cash flow from day one. So those are some. We have a lot more. I'm kind of hitting some highlights here about a whole list of different aspects, but just because of time. If you're coming into a deal and you have a partner, this happens a lot, and it can result in things later on. You're buddy up front, and maybe something happens, and now you have to make a decision, and you want to make a decision to do something, sell a property, refinance it, or whatever that might be. If you're 50-50 partner, you need a tiebreaker. So you need a tiebreaker built into your operating agreement that allows somebody to break the tie. If not, then you're just stuck. It's better to go slow instead of fast, be in a hurry. There's no question, this is a lesson learned here for sure, personal lesson. And then set your investing limits and abide by them. So I know people, myself included, where you say, I won't invest more than X in a deal, but the deal looks really good, and you put more in. I know a guy right now that, just feeding a deal, and he has a ton of money. I've fed deals as well, and set your limits and try to abide by them as much as you can. And, a good deal today might not be a good deal in the future. Expectations, the market will go down much faster than it goes up. Just reality. It's not a good thing, but it is reality. Force majeure can make the market shift. We saw that, perfect example during COVID. Time can and will kill deals. You don't want to be the bottleneck. A deal's not closed until the money has been wired. So between buying and selling, I've done well over probably 170 deals combined. And we had a deal that was, for all practical purposes, closed. They missed the wiring cutoff for the day. The very next day, they're supposed to wire the funds. This is the deal we were selling. And they came back and said there was a prep equity group that's involved in the deal, and they now have an issue with their prep equity group. And now there was a legal, attorneys were involved, and it did close about a week later, but the deal is not closed until it's closed, unfortunately. Understand cash versus accrual financials. You don't have to be a CPA to understand that, but just think of it this way. If you have cash coming in, someone gives you, $1,000 for rent that month, that's $1,000 on the cash basis. If someone doesn't give you $1,000 because they're just late or they're not paying you right now, accrual financials for revenue would include that as revenue. They accrue it, but it hasn't been paid. So I don't want to spend a lot of time on this, but just make sure when you're investing in deals that you really understand the difference between cash and accrual-based financials. I could show you examples that literally blow your mind, the difference between these two from a financial perspective. Review crime in the area. So, crime exists almost everywhere. I mean, even in Class A properties, crime exists. But what happened is a lot of properties that didn't necessarily have high crime, but there was high crime in the submarket, a year and a half ago, became a lot of issues with lenders. So just be cautious of buying in areas that are high in crime. And if you think you're going to come in and change a neighborhood, you better buy, a block or two, whatever it might be, to do that. It's really, really hard, in my opinion, just to put cameras up or gates up. That doesn't change necessarily the crime in the area. Older buildings typically have a lot of issues, whether it's plumbing issues, chiller. Chiller is more of a, one machine, heating and cooling, multiple units all at once. If it goes down, multiple units are impacted. We had, a chiller property, middle of July in Texas, 100 and some degrees, went down. Every unit was out. So that's not a good situation. And then it's not just the chiller, it's all the plumbing underneath. That can cost hundreds of thousands of dollars. So just be aware of that as you look at older properties. Be aware of some electrical panels. It seems like every year there's some sort of new panel being added to the insurance list that is potentially increasing your insurance costs substantially. And in some cases, the insurance company won't even renew with you. So understand that when you perform due diligence, inspect 100% of the units. Make sure you always also perform financial due diligence on the property. The one above, while this is a difficult ask, but I would recommend this. So many properties that you buy, you're told, hey, you can go walk the vacant units before you close, and then you get some sort of credit, typically. More times than not, by far more times than not, there are more units that are not occupied. So you want to be able to walk more units and figure out what is really occupied and what is not really occupied. Engage a property tax consultant before going under contract to purchase a property. You can sometimes appeal it, freeze it. There's some other interesting things you could do in certain parts of the country. We have one where our insurance is, our tax is basically zero. It's kind of a pretty cool program. We have other ones where they're cut in half and frozen for 20 years. So those were all some other potential alternatives, and might make sense to look at those markets where those tax consultants have these programs that they can make you aware of. Understand the property management agreement terms. This is more for probably really the operator. Be surprised what some PM companies try to include. They try to have all these fees added, and you can't terminate. You terminate, we charge all these other fees. They get incentivized for leasing units, but don't you think they should be more incentivized for actually having paying tenants? So just got off a call actually on a PM call, and they're like, hey, we're going to get, this is what we get for leasing the unit. And they want it paid up front. Well, if that tenant doesn't pay on time or they get evicted or things like that. So just be aware. There are a lot of things as you go through this, tough lessons learned that you're going through a transaction and you don't necessarily know what to look for until you're like, at the end, you're like, hey, this is something that, you're kind of caught on. So make sure you understand all those agreements inside and out. Cap rates, we all love them when they're compressing, but it works both ways. Properties that there's no question across the country, multifamily has gone down, in some cases substantially. But if you have a deal that is not, qualifying for agency debt, so, Fannie, Freddie, HUD, then you're taking, an additional 20, 30% hit on values because interest rates went up, more than double on bridge debt. So just be aware of that. And that does impact cap rates, which will significantly increase or decrease your value. Know when you do or do not have any negotiating leverage. If you're in a deal, don't be a hothead, if you want to say. Be easy to work with. Be a win-win situation, not a pushover. But know when you have negotiating abilities, when you don't. We have one example where we had a deal. They have a transfer tax that was pretty high. It's in Tennessee, and the contract was signed, and then the broker came back and said, "Oh, the buyer missed this. You guys as the seller should pay for this." It's like, well, we have a signed contract. So reality is we negotiated some other things around that, but we had a very strong negotiating position there because we had a signed contract. If they missed it, that's on them. So know your PSA, which is your contract inside and out. There are literally a couple words here and there that that can make major differences on what you owe as a buyer or as a seller, whether you can force someone to sell to you or whether you can't. A long time ago, this is almost 10 years ago, I partnered with a guy, and we got into a situation like this, and there's some verbiage in the contract that can basically force you to do certain things. So make sure you understand the contracts very well. Never guarantee. People will sometimes send things to say, hey, there's promise of this or guaranteed return. No different than a stock. You should not be guaranteeing a return or performance or anything like that. Just like a stock, money can be lost. Unfortunately, there's definitely an expectation that syndicators, GPs, kind of feed projects and things like that, which I've done personally on a number of deals. But reality is, if you had a stockbroker, you're not going to ask your stockbroker to put money in typically into the stock because you lost money on it. So just understand, this is an investment, just like any other investment. There are risks involved in the investment. Nobody likes it. It's sickening to your stomach when a deal goes south, but there is risk. Be a good partner. We're all trying to work together. Some cases during some difficult circumstances, especially over this last year, no question, been a lot of difficult situations, but try to work together. You don't have to be, if you want to call a jerk about things. Let's try to work and solve things together, and then build long-term relationships, whether that's with insurance, attorneys, lenders, property management companies. Give you an example. If you're working with the same lender over and over again, you're going to most likely get more favors from that lender. If you're going to shop every deal you do to different lenders, then you're not going to probably get as many favors. We have a property management company right now that, I just asked them for a concession, basically no management fee and 2 resources free for 3 months. And they agreed to it. Why? If it was the only deal they had with us, they wouldn't have agreed to it. But the reality is we have a good relationship with them, and they're trying to continue to do business with us. If you're familiar with the term private equity, that's basically you have the main senior debt lender, and then you have these private equity groups, and you can be an investor in some of these groups as well. They sit right after the senior lender, and then you have limited partners after that. So if you're in a position where you have the option to invest, equity is private equity, I think it's something you should seriously look at. It puts you in a better position. You want to raise more than you think you'll need. Can't tell you how many times, get surprised by something. So make sure you have more than what you need raised. And then CapEx, have a contingency, probably minimum 20% contingency. And you can wait a very, very long time. So some lenders, if they put CapEx in the loan, after a certain period of time, they'll force fund it, basically, meaning they'll start charging the interest on the full amount, including the CapEx, whether it's used or not. The other thing is, if you're going through it, is we have, examples where one lender right now, they're saying you can't actually do a draw request, which is, hey, lender, we spent money, please reimburse us. Can't do a draw request for 30 days after the last time they reimbursed you. So now they're saying 90 days. So, not to get into math, but if a vendor missed that timeline there by a day or two, you're talking, close to 4 months before some of these lenders really are reimbursing you on money is being spent, or they're doing, two-party checks to vendors. So just be aware. As time, we have lenders before that said, they cut off all CapEx to every one of their borrowers. So you need the money there, you need contingency there. Everyone's going to say conservative approach, I'm not going to overuse that. But reality is you might not know you're in a bad market till it's very bad. It doesn't pay to say, hey, it can't get worse or last much longer. Reality is it can, and it might last longer than you ever want. 1031 investor challenges. I could probably do the whole thing just on this, but a lot of things around this. 1031 investors, one, they may be on the loan as well, just so you know, if you're signing as an investor. 1031, you have the whole situation where they may have decision-making rights and hold things up. They may or may not have the ability to do that. So there are a lot of things around 1031 investors that you just really have to be aware of. And we've learned a lot of lessons from that. If you meet your business plan early, take the game, in my opinion. Move quickly, sell at a fair price, move on. Look for creative ways to reduce your expenses. I mentioned some of the property tax programs, and then provide input to the PM companies. As much as we all like to believe that, the professionally managed, property management companies, think of everything and get all the direction from their oversight corporate, they don't. Perfect example, I was just on a property last week, and I was questioning the on-site, and I asked, hey, you're getting any pushback on the rents at all right now? This is a property that's been leasing up. And she's like, no, not at all, and in fact, we have a waiting list. I said, so you're getting literally zero pushback on rents right now, and you have a waiting list, so time to increase rents. And you can always try it, right? And maybe you start getting pushback, so you need to find that sweet spot. But I can tell you, if you have a waiting list and no pushback on rents, you need to push rents. Rehab speed is critical. If you're trying to do a large project, this, kind of call it chuck in the truck. I've got a properties before, huge rehabs, and there's like 3 guys there. Speed is critical, especially if your business plan requires you to deploy capital on deals, right? For CapEx projects. And also, if you want to start pushing rents higher, you want to be able to get those units turned. Or if you want to make the exterior more appealing, you want to make sure that you get that done quickly. Draw requests to be a major priority. I mentioned about draw requests already. And then replacement reserves, if you're not familiar with that term, but some loans you're putting in extra money for what's called replacement reserves. You just want to make sure that you're requesting to get that back as appropriate. So this is all money that you, the borrower, are in some cases owed, and at some point in time you are owed that money. So just be aware of that. If you can do it, you try to get the loan payment so it's not due on the first of the month. Some of these properties, especially if they're the larger value add deals and or they have cash flow issues, trying to collect rents and pay rents and pay the mortgage on the first, second, third, or fourth of the month, it's harder, right? So not an issue when you have all the cash sitting there and come in. But if you're in a cash crunch, you want to try to get your loan up front to be later in the month for a payment. When you're selling a property, this concept, and if you haven't been through a process, I can tell you this can be involved, but these must take service contracts. So you buy a new property and there's certain contracts in that you might have to take as a buyer. And as a seller, you might have to cancel those contracts, but just make sure you know which contracts you have. You would assume that the PM company knows all this inside and out, but sometimes you're changing PM companies and some things get lost in the shuffle, right? So make sure you know all the service contracts. And then when you're selling a property, you want must take contracts, meaning the new buyer has to take certain contracts. And then be aware of depreciation recapture as well when your property is being sold. I won't go into a lot of details on that at the moment. So, deals in trouble. Again, this could be just one thing by itself, but your net worth doesn't pay your bills. So and it can be wiped out very, very quickly. So be aware of that. You want to get current broker opinion values, stabilized broker opinion values. I will say that a lot of the broker opinion values that have come over in the last, let's say 6+ months have been far off from what the market really was willing to pay. Just reality. Brokers are trying to figure out as well where the market's going to end, what people are really willing and able to pay. But you want to have some data points there. You have this concept of member loans versus capital calls. Main difference being member loans will sit in front of limited partners. There's typically an interest rate associated with that. It accrues. It's not guaranteed. You shouldn't guarantee it because you have to have funds there to be able to cover that. So just be aware those are some different things to have in place there. Loan modifications. That's where you're going back to the lender asking for certain things to change in the loan. Most cases, that will require some sort of equity contribution to the lender to do that loan modification. So be aware of that as well. And then ask for price breaks from vendors. These are, if your PM company is working with vendors that they have on their list and they give them a lot of business, ask them for a price break and or ask them to do some sort of installment for the payment. So does a deal have upside? So, if the deal, this is tough, right? If a deal based on what the data you have doesn't have the upside, then you shouldn't go back necessarily and keep throwing money into it. And not telling you what you should or shouldn't do on that. I'm just saying if the deal has no upside to it, you're going to have to make some very, very tough choices. Be flexible and responsive when you're working with lenders. Asking for additional funds, discuss the harsh reality. Harsh reality is, a lot of investors, they'll make, statements that lenders don't want deals back. They don't want to foreclose on deals. And I would say for the most part, that is true, but that doesn't mean it doesn't happen. It can and will happen. You can't continue not to pay a mortgage. So the harsh reality is that, you can either sell at a lot of deals would have sold at a complete loss, or get foreclosed on, which is absolutely a full loss of equity. So it's not a scare tactic. It's laying out what the reality is on a certain deal. Some life lessons. Check your pride. I've dealt with a lot of people that, they kind of puff their chest up, if you want to say, and make statements or do certain things. So just make sure your pride isn't getting in the way of you making the right decisions. Focus on what you can control. I think, myself included, 99.9% of what I worry about right now are things either in the past or things that haven't happened yet in the future. So it's hard. I understand that when you're going through tough times for sure, but try to focus on what you can control as much as possible. Focus on what you have in life and not what you don't have. I'm guilty of this as well. And then I look at examples of, one of my best friends, his wife has stage 4 cancer. And that can't be fixed with money, unfortunately, right now. Simplify your life, as much as possible. When you're making purchasing decisions, what's the true cost of owning something? If you go buy something, what does it cost afterwards? As you buy a nicer car, well, maybe I'm making some of these things up. Your tires are more expensive, your insurance is more expensive, the gas is more expensive. So just make sure that you understand the true cost of owning something, and then do what you enjoy, not what others think you should enjoy. So if someone's like, hey, you should go play golf, you should do this and that, and you don't like those things, then do what you enjoy. It's your life, and do those things that make you happy. Reality is that a lot of things that probably make most of us happy are related to memories, family, friends, spending time together, that have, really, in a lot of respects, very little to do with money. And then you have to decide, do you want things because other people have them, or do you really want those things? So someone else has a boat, you say, I want a boat. Okay, well, do you really want a boat? Do you like boating? Just those decisions you have to make. Again, think about what makes you happy. It rarely involves money. It's people and memories. Have friends who encourage and pray for you. Find someone you talk to about your anxiety, stress. This is hard when you're going through it, because in cases you don't want to even talk about it. But find those people, rely on God, as much during good times as during the hard times. And with that, there's no question I have, many lessons learned during, doing this, painful, hard, stressful lessons. I don't want other people to go through what myself and a lot of people have gone through over the last year. But my contact information is mark@thinkmultifamily.com. And hopefully you got some tidbits out of this. And, does it make sense to keep looking for properties? Personally, I think that there are deals that will be coming that will look like good deals and most likely be good deals. I think we're kind of at the bottom of the market. I'm not going to say that for sure, but I don't want to discourage you necessarily either from continuing to invest. I think you just have to do things differently maybe than we have. And also the number one thing is to eliminate as many of the unknowns as you can before you invest. You can never eliminate them all, but with that, I appreciate your time. And again, mark@thinkmultifamily.com, and reach out to me. Thank you.
Okay, wonderful. I hope everybody enjoyed that. I'm going to share Mark's information in the chat as well. I know it had it up there, but in case you didn't get a chance to write it down, there is Mark's email address as well as the URL to the Think Multifamily website for y'all to check out. And hopefully ask him some more questions. I saw we did have some come through. I will try to get to those as best we can. And if there are any other questions in the meantime, please put those down in the chat. I am going to go through just some information from the Quest side as well, and especially for those who maybe are new to our services and kind of what we provide outside of just the real estate and investment education. What Quest does, we are a self-directed IRA custodian, meaning that we really enable people to take their money out of the stock market, out of those more traditional investments, especially qualified money. We're talking about money in a retirement account, and utilize those funds to put into some more alternative deals, right? Multifamily investments being a big one, really any kinds of real estate, private companies, cryptocurrency, private lending. There are all sorts of things. So that's a little bit about what we provide. And certainly this is something that you can invest in through a self-directed IRA if y'all are interested. So if there are any questions about that, please let us know. You can even schedule a consultation with an IRA specialist, whether it be myself or someone else. We are all here to help answer questions, determine what is the right fit, maybe what accounts make sense for you. We can discuss the different tax benefits and advantages of using these IRAs and things like that. So I certainly encourage, if y'all are interested, to schedule a consultation, check out our website, look at what you can do with these IRAs. And a little bit about some of our events as well. So the Expo is at least the biggest event that we have coming up. That's going to be the end of June. So it'll be Thursday through Saturday, the 27th through June 29th. This is going to be one of the largest alternative investment conferences of 2024. So we're holding it there in Irving, Texas at the Las Colinas Convention Center. And you can scan that QR code to learn more. I do want to talk about this a little bit after we play a quick video. So there's kind of a video that we made from our last expo back in 2022. We typically do these once every couple of years. So I want to give y'all a little glimpse at what this will look like. If we can bring this up here. Bear with us for just a moment. See if we can get this to work.
Right here, right now.
So we are here because we want to meet as many investors as we possibly can. Quest does a great job at putting people here at the event. This event, I think, is great for first-time borrowers, first-time investors, and experienced investors. This event is great for finding funds that could fit their investment needs. I get a lot of business from the Quest event. I talk to people, I network with people, and it actually becomes business after the event.
Okay, so just a really quick glimpse kind of into what the expo is all about. Bringing people together, whether you're a first-time novice investor or much more experienced, maybe you're somewhere in the middle, regardless of what your alternative investment strategy or interests are, all the way from short-term rentals to private oil and gas and mineral right deals, to we'll be talking about like the emergence of technology and artificial intelligence at the expo and kind of how that's impacting real estate. So there's going to be a ton of great panels, great keynote presentations and speakers, people there to answer your questions, vendors for you to network and other individuals to connect with. So this is really our big culminating event, and we always enjoy kind of the preparation in this and putting them on. We're hoping for close to 1,000, if not more, people in attendance there. The venue is absolutely gorgeous. I really encourage y'all to check that out. So it'll be the Quest Expo again, June 27th through 29th. And actually right now we have a promotion. Typically general admission tickets are $450. Right now, we are actually promoting them for 50% off. This is only for the first 150 people to take advantage of this. And Kamea put a link down in the chat where you can actually purchase your tickets if this is something that you're wanting to do. Highly, highly recommend that y'all take advantage of this now, because this will be the biggest promotion that there's going to be, especially leading up to the event. So take a look at that. This only applies to general admission. It doesn't apply to the VIP tickets, which are priced at $850, I believe. So I think we started this promotion back on Friday of last week, and I think we're probably, correct me if I'm wrong, up to maybe 30 or 40 already. So take advantage while you can. 50% off all tickets for the expo. General admission tickets for the expo. This is the other promotion we have going on right now, not expo related, but for our accounts. Since we are getting really, really close to tax filing deadline, we're less than 2 weeks away now. We are setting up all new accounts for free. Typically, we charge $100 to establish an IRA. We're totally waiving that fee right now. If you want to set up an account, maybe make some contributions before the tax deadline, whatever it may be. This is really one of the best promotions, best advantages you can get when getting started in the self-directed space, right? No cost at all to set that up. So not something we have very often, but it is going to be available for the next couple of weeks ending on April 15th. So either set up your accounts on or before that date, and the fees will be completely waived. The last one here is the May socials that we will be doing in each one of our offices. So if y'all are local to Texas, whether or not you've been to our in-person events before, our next Social is focusing on veterans turned investors. So we're actually partnering with the Wounded Warrior Project to kind of talk about, we'll have some veterans and them to be able to talk about their experiences leaving the service and kind of how they got involved in real estate alternative investing. So Austin will be on May 2nd, Houston on the 7th, and then Dallas finally on the 14th. At each of the branch locations there in those respective cities. So check those out. Again, if either maybe you're a veteran yourself or somebody who could really find some use out of this and benefit, certainly send them this information. Again, this info is on our website as well. You can scan the QR code, and there's a link down here to our events page as well on the website. So check it out, send it to your friends and family. We're going to have not only the education portion, but also our typical, networking, food and drinks that we do at all of our in-person events. So I think that's all I've got for y'all for today from the Quest side. And really the only question I saw come through was really, I'm not going to, claim to be an expert in multifamily. So this is probably a question more geared towards Mark. Are there examples of verbiage that can force the seller to sell or a buyer to buy? So yeah, I would shoot an email to him, maybe see if he can answer this question, if you can set up some time to speak with him or somebody on his team. They're great working with investors and certainly happy to help answer any questions, I'm sure. But I think that is about all that we have. So again, I just want to throw this up here one more time. The link to purchase your tickets for the expo, take advantage of it now while you still can. Otherwise, if there are no other questions, we'll get out of here a bit early today. Let you all get back to enjoying the rest of your Tuesdays and the rest of the week. Hopefully, we'll see you next time for this upcoming self-directed IRA Saturday. Again, the events page here, you can check out to register for that one. We've got some great events coming up and webinars, so take a look. Hopefully, we'll see you all next time. Everybody enjoy the rest of your Tuesdays, like I said, and thanks so much for joining.